So the price of gold is going through the roof in 2026, right? But the reason, well, it's probably not what you're thinking. Today, we're diving into a really provocative new idea that says this has less to do with inflation and everything to do with a fundamental breakdown of trust between allies.
Okay, so this right here, this is the big idea we're going to unpack today. The whole argument is that the fundamental rules of global finance are being torn up. And gold? Gold is the canary in the coal mine, the first big signal of this massive shift.
You know, if you talk to most investors, they'll tell you gold is archaic, a relic. But that's because they're looking at it all wrong. They're analyzing it like it's just another commodity, like corn or oil. But the reality, when you look at recent US tariffs on Europe or all this strategic pressure on Greenland, that's not commodity talk. That's geopolitics. Gold is sending a signal, a big one.
All right, but before we go all in on this new theory, let's do something really important. Let's steel man the other side. What's the best, smartest argument against owning gold right now? Because, to really understand an idea, you've got to grapple with its strongest opposition.
And really it boils down to something you learn in Finance 101, opportunity cost. The consensus view, the comfortable view, is that, hey, it's 2026, interest rates are up, so why on earth would you hold an asset like gold that pays you absolutely nothing to own it? There's a real cost to holding something that just sits there.
And this slide just lays it out perfectly, doesn't it? The standard choice. On one side, you've got tech stocks, government bonds, stuff that actually gives you a yield, a return. It's the engine of growth. But then on the other side, you've got gold. No yield, you have to pay to store it, and let's be honest, it's seen as this archaic asset. So for most people allocating capital, the choice looks like a no-brainer.
And on top of that, the mainstream view just kind of shrugs off all the recent geopolitical drama as, well, noise, political theater. They see the U.S. tariffs on Europe as just a temporary squabble, a bargaining tactic, not some fundamental change in policy. And all the talk about Greenland, that's just a distraction, right? That's what they think.
So, you see where this is going? The entire case against gold, the whole mainstream argument, it all hinges on one massive assumption, that we're still in a unified global economy. And look, if you believe that's true, then yeah, selling gold is probably the only logical thing to do. But what if that core assumption is just wrong?
And that's our pivot. This brings us to the big idea, this huge structural shift from a world that was unified to one that is, well, breaking apart. And the whole counterargument, the whole thesis we're exploring today, it all comes down to this one powerful idea, trust deflation. And let's be clear, this isn't your typical inflation. We're not talking about the value of a dollar going down. We're talking about the value of a promise going down. And when trust starts to evaporate, what becomes valuable? Things you can hold, physical, uncontrollable assets. And look at this. This really paints the picture of the paradigm shift we are living through right now. We're literally moving from the old world of global unity and, diplomatic goodwill to a completely new paradigm in 2026, one that's all about fragmentation, strategic geography, and alliances that are purely transactional, even with our oldest friends. So if your whole view of the world changes like that, it makes sense that your idea of a safe asset is going to change too, right? Radically. We're shifting away from assets based on paper trust, things like government bonds and international contracts, and we're moving towards assets based on hard control. Physical gold, rare earth minerals, even strategic chunks of land like Greenland. And this next point is absolutely crucial. When you see central banks buying up gold, they're not day trading. They're not trying to make a quick buck. No. They are buying an exit ticket. They are buying their way out of a system where their own financial reserves can be turned into a weapon against them.
Okay, so this all sounds a bit abstract. I get it. Trust deflation, paradigm shifts. Let's bring it right back down to earth and connect it to the headlines you're seeing every single day. Because this is where the theory smacks right into reality.
Think about it. When the United States, the issuer of the world's reserve currency, starts talking more about the strategic value of Greenland's geography and minerals than about its diplomatic relationships, that's a signal, a huge one. It tells anyone with smart money that hard, physical assets are now being valued more than soft alliances and paper promises.
And the tariffs on Europe? This proves it's not just talk, it's not theater. By hitting EU exports, the US is sending a crystal clear message. Even our oldest allies are now viewed as economic competitors. And if you're Europe, what does that force you to do? It forces you to find a hedge, a safe haven that's completely outside of American control. Because suddenly the dollar system doesn't feel like a guarantee anymore, it feels transactional.
Now look at this chart. This is kind of the smoking gun right here. For decades, the relationship was like clockwork. When real interest rates went up, gold went down. Simple. It was one of the most reliable correlations in finance. But now, look at 2026. The whole thing is flipped on its head. It's completely inverted. That doesn't just happen. That's a massive flashing signal that some new, more powerful force is driving the price.
So what this all means is that the fundamental question that big money is asking has changed. The old question was, what's the cost of carry? What does it cost me to hold this non-yielding thing? But the new question, the 2026 question, is what's the cost of access? What's the risk that someone can just turn off my access to my own assets? And gold has no counterparty, no one can turn it off.
Okay, I know what some of you are probably thinking. This sounds pretty grim. And for anyone steeped in traditional finance, it's a really uncomfortable idea. So let's do this right. Let's take on the strongest objections to this thesis head on.
And this is the big one, right? The default counter-argument you'll hear everywhere. Come on, the US economy is strong, the dollar is at a high, this is all just a temporary panic. Once things calm down, gold is going to crash.
But that argument completely misses the point. It's based on the idea that this is all driven by emotion, by panic. It's not. Tariffs aren't feelings. Strategic moves for territory aren't feelings. These are structural changes. These are facts on the ground. You see, panic fades, but a tariff is law until it's repealed.
All right, the other thing you'll hear is, okay, but the market's smart, all this risk is already priced in. But is it? History tells us that markets are actually terrible at pricing in these kinds of massive regime changes. They're built to analyze data, spreadsheets, earnings reports. They are not built to price in a fundamental shift in the entire philosophy of how the world works.
So really, the key is to see the headlines for what they are. The tariffs on Europe, the talk about Greenland, these crazy correlation breakdowns, they're not the story. They're just the symptoms. The actual disease is a deep, fundamental, structural breakdown of trust between allies. And that's why in 2026, you don't own gold to get rich. You own it because the very definition of safe money is being rewritten right in front of us.
So in the end, this whole conversation, it's not really about a shiny metal. It's about how you see the future. It's a fundamental question about global cooperation. So you have to ask yourself, is my portfolio built for a world of global unity that might not be coming back? Or is it positioned for the fragmented reality that all the signals are screaming at us? That right there is the big question.